Okay, welcome to smarthelping.com. Jason Warner here. We are going to do an overview of the franchisor licensing model. It's a 10-year financial model. It's got full three-statement model integration as well, and it's one of the most comprehensive things I've ever built. If you want it, check the link in the description box below. I'm going to go through each tab and explain how the assumptions work, and then we'll go over some of the summaries. So initial control tab, we've got some things here, naming of the company, the start year. This is a change. I used to do start year and have you do the date, but now it's just the year, so it removes a lot of confusion there. Um, Remember, you're going to only edit cells in light yellow with blue text. The end year, sorry if I cough, I've been sick. Um, the exit month, end year, and this can be NA. You can do NA and it'll just run into perpetuity with no exit value, or you could do some month before. It doesn't have to be for 10 years. It could be for 3 years or 5 or whatever, even for 1 year. The exit value based on percentage multiples. There's some seller fees in here as well. Then we've got cash sources for debt, and then the rest of these sources will be defined on the cap table. And we also got income tax rate and long-term capital gains tax here. Next up, build out. So this is the main meat and potatoes of the model. This is where you define, so for a franchisor, you're operating, you're basically selling the rights to trademarks and special, your business model that you think is really good. You're letting people come in and as franchisees and use your trademark and they pay you a fee. That's what the model is at the highest level. So I figured the best way to do this is do it by location type. So you can plan up to 3 location types. These could be different regions, different countries, different areas, different types of locations, whatever what have you. You've got 3 types to plan out. You can pick their start month. You can pick your royalty fee that you're charging them. Also an ad fee if applicable. Some franchisors do an ad fee separate from the royalty. Some just do one royalty fee, or some people just, yeah. Um, so I just did the ad and the royalty as separate, just so it's more granular, it's better, best practice. Also, you could do upfront fees as well. So, like if you want to join McDonald's, you gotta pay them a fee, like I don't know what it is, 50,000 or something, just to even start the onboarding process. And then you pay them a percentage of your revenues or gross profits over time, depending on how the deal is structured. The rollout assumptions are pretty granular as well. So you can define the initial launch of locations, and then after that, you can define how many locations you think you're going to add a month, and then you can define the percentage that you think this will grow over time. For example, if this is 1%, it means you had 1 location in month 1. In month 2, you add 1 location plus 1%. The reason I did this is because you might be launching with more locations, but then you want to define a different amount of growth for locations over time. And then you can define that growth here. And all this says is eventually you might be adding more locations in the future than you are right now per month. You also can define the franchise. You can define the franchisees' revenues. So this is how much your franchisees are making, and that's going to be a direct function of how much you make as the franchisor because you get a percentage of their earnings. That's the whole deal. So you can define that amount here by location type, and you can also define the expected annual revenue growth of franchisees depending on what year they joined, and you can define the years of growth, and then they'll grow up to that point and then stabilize. Because these are going to be mostly, they don't have to be brick and mortar, but usually they are, and that means you reach some capacity and then you can't really grow anymore. However, if you think it's going to grow the whole time, you could always put this to 10 and it'll just apply this rate to the end of the model for every year. There's also retention assumption. So this says, not every franchisee that comes on is going to last. So the metric here shows you the annual retention. I just looked up a general stat, said after 5 years, usually 95% of franchisees are still in business, so only 5% are going out of business. Um, so that's a 99% retention rate on an annual basis. So this applies here. It can be different by industry. You can look it up. It depends on what sector you're in, but that is another input for you. Next up is onboarding costs. So this is if your franchisees come on. Most people don't know this, but the franchisor is going to have costs like recruitment, training. They're going to have a lot of upfront costs to onboard, and that's a risk, and that's why they charge an upfront franchise fee. But oftentimes, or almost never, the franchise fee is not going to cover this whole amount. So there's going to be some amount of months of operations that have to happen before the franchisor breaks even. And I have done that calculation. You'll see it in the monthly P&L detail. So these are a one-time costs that the franchisor bears every time one of these location types is added. Then I did the same thing but running costs. So these are the costs per month that the franchisor is going to pay per location. So ongoing. Then we've got operating cost schedule, which is just a fixed cost to run the franchisor. So this would be like legal fees, CEO, CFO, maybe heads of marketing, things like that. So just fixed cost schedule, pretty simple. There's also a catch-all here if you can't find somewhere to fit something. This is a direct percentage of revenue, an expense that's based on direct percentage of revenue. And you can also define start months for all of these. Startup costs, just one-time costs that can't fit anywhere else, and these would happen before the first month of operations. Or if you, it's another kind of a catch-all, but it's for things that, like, let's say you're going to do a gigantic web design or website, and you want to have that ready before launch. You could put that cost in here, or some R&D, or a reserve, even for reserve. The main output that this model will solve for, besides creating all the income statement and financial statement reports and distribution schedules, is it's going to solve for the minimum amount of equity needed to get this thing off the ground, which is going to be a pretty direct correlative function of the startup costs and then any burn that happens usually in the first couple of years based on your assumptions. CapEx schedule. I just did up to 15 here. It's kind of generic, plus a building. If applicable, you put the initial costs here. Useful life is going to do depreciation. Month of expenditure is the month you actually onboard whatever the cost is. The building is separate from the other fixed assets because of the logic we have going on for when it's sold. And also, there's just different logic here. So the building is something that always has to be in row one. There is smart functionality here for the net gain and loss. So on exit, if you do enter an exit month, there's going to be a amount of money there, and some of it's going to be applied to, if you see the terminal value here, some of it's going to be applied to extraordinary income. So this is just like your it's not applied to any fixed asset or anything. It's not offset against that. It's just income that you got to pay taxes on. So the other 5% of that, which is this amount, which is applied to everything but the building, is then spread out over these fixed assets, and then you get a gain or loss on fixed asset, and that's going to be a different tax rate. So essentially, this is all just to do more accurate tax calculations, as well as create a depreciation schedule from this. So that's the CapEx table. Terminal value, I just showed you what that is. Cap table, this is pretty nice. So this is the minimum equity needed based on all the assumptions. Then we've got total amount of shares you want to issue, the percentage. I did 3 types: common, class A, and B. You can define all of this logic and based on whatever your deal is that you want to do. And then you can define, I did up to, what is this, 20 count of outside investors, the amount that they contribute, the percentage of stock they get for that contribution, and you could do percentage of class A and B as well. And then if you go over, it has fully diluted ownership, which is just their share of the company essentially. And then here's the share amount, and then the implied valuation based on the amount that they're getting relative to their contribution. Then I did a catch-all here at the bottom that's just taking essentially all the funds that have been collected from insiders as well as owners, operators, employees, founders, which might contribute, and all that amount less the initial equity needed just flows into this last slot, which allows you to enter any numbers up here, and this is still solved for. You can also enter, so like I said, founder information here, and it's got the same logic for percentage ownership, and that all is going to flow to the balance sheet and distributions. There's also an IRR for each individual row or slot that shows their share of the distributions and the resulting internal rate of return based on their contribution at the beginning. Just some checks there. This is this is actually the first model I'm integrating a cap table onto, so I thought this was pretty cool. Debt schedule, again, this is just based on the amount entered on the control tab, and then this will flow through the model accordingly based on the schedule. The payback month is going to be assumed to be the month of exit if there is an exit defined. Executive summary, high-level items. So, total franchisees onboarded over time, ongoing revenue, one-time fee revenue, your total revenue, percentage growth each year, location-specific costs, which I'm calling that, setting that against here. It's almost like a variable cost. All right, I would say it's a variable cost, not a cost of goods sold. Gross profit therein, and then you got your G&A, sales, marketing, R&D costs, total expenses, EBITDA. Then we have a bunch of items down here. Then you get to cash flow after equity. Oh, and one thing I'm going to add to this, I'm not going to do it right now, but I got to add taxes and capex to this because this was the three statement model was done after this, and this doesn't normally have that in it, so I'm going to add that real quick, but that's no big deal. Distributions. So this is showing the initial equity needed, and then as it's used over time, you can see it here, and then any amount remaining would be distributable cash flow. And then this is also checked against the balance sheet cash flow to make sure the total cash matches that. There's also a discounted cash flow analysis for the project here, internal rate of return, and then the investor amount and owner amount, and this is based on the cap table definitions for insiders, which is insiders would be operators, outsiders would be investors. Their share of the cash flow and their resulting IRR and net present value for them as well. Visualizations, we got fee revenue, revenue less fee per location cost. So this is like gross profit. Average months to break even. This is a really important one. So this shows you based on the total onboarding costs, less the franchise fee collected, like the one-time fee that they, so you basically have the net, how much the franchisee pays you, less how much money or costs you have to onboard them. And then that amount is divided by the amount of monthly gross profit per location, which is the ongoing royalty fees less the ongoing costs. And so that amount is how much you make each month. You just divide the total net cost by that to get the amount of months. So this is a very important metric as well. We've got franchisee locations added per year and cumulative. Licensing fee revenue by location type, one-time fee revenue by location type, ad revenue by location type, average monthly fee revenue per location. So this is monthly fees on average what you're making for a given location. So every month for one location on average. There's also average annual revenue per location by type with so this is annual. So this is the same thing as this, but it's annualized and it's doing it by type. This is average monthly revenue per location by type. Wait, so this one, average monthly fee. Yeah, this is ongoing fees. So this is the average of everything, all three location types. This is showing you each location type individually per year. This is showing you the average monthly amount by type. So this chart here, the average monthly fee is the same as this one, except for this one shows it by type instead of just doing the average. This shows it by type on an annual basis. Then we've got average monthly revenue after location specific costs. So this is the same thing as this is the same thing as this one, except for it's subtracting out the um, location specific costs. And then this is doing the same thing, but on an annual basis. So this is the same as that one up here, but this is on an annual basis. Then we got annual EBITDA and revenue by type, ongoing versus one-time fees. So lots of charts there. Monthly P&L details. So this shows you, based on all those assumptions, what's happening over the 10-year timeline based on all these different things. You've got location-specific stats. How many are added per month? What's the total added? What's the churn based on that retention rate? What's the total remaining locations? This is used in the matrices a lot in M1, M2, and M3, which you'll see at the very end to figure out all the different fee revenues and growth and all that. Revenue and fees. So this top part is the total franchisee revenues. So this is what the franchisees are making, and this is the share the franchisor gets of that based on the percentages defined. Ad fees, same thing, percentage of revenue for ad fees, and then one-time fees here, and then total one-time fees. We also did average upfront fee per location, and then you got total revenue, fee revenue here, which is going to be all three of these: upfront fees, ad fee collected, and franchise fees collected. So you got basically one upfront and then two ongoing. Then I did some more in-depth calculations here that show on average per location what's the ongoing fee revenue equal to per month. And that's going to be a function of how much revenue each location's having, what's the growth of revenue over time, and then it's going to give you an average of how much you're making per location on any given month based on all those assumptions. Then we've got location specific costs broken out here. So these are the onboarding costs, one-time costs for the franchisor, ongoing, and then ongoing costs for the franchisor, resulting in total ongoing costs. And then you add those together, you get and subtract it by the total revenue, and you get your revenue less location specific costs, and then that percentage. Here's the months to break even, which is a very important calculation. It's looking at the total ongoing costs less, or total revenues, total royalty revenues minus ongoing costs, and then it's dividing the initial onboarding costs minus the initial franchise fee by that, and then that gives you the amount of months it takes to cover that. Then just the OpEx stuff here is pretty straightforward. We got EBITDA, startup costs, debt service, all different cash flow items. CapEx, taxes, and sale of building. I'll have to add that to the executive summary, these three here. But they are all added and integrated into the monthly P&L detail already in annual. We also got some more stats down here. Average ongoing cost per location by type, average revenue after ongoing cost by type, and those go into the charts. That's why we had to do those. So annual does the same thing as a monthly, just on an annual basis. And then we have income statement, monthly and annual. So this just is more formal. It has some taxes on here. I aggregated the OpEx costs into their high-level category items. variable costs. These are variable costs, not cost of goods sold. Formalize, it's got the name, the title of the statement, the months included. And this all updates too. If you update the end month, it all adjusts accordingly. You see here, this is where some of the tax logic is happening on the exit month. Here's a check. So income statement monthly, income statement annual, same stuff but on an annual basis. Balance sheet, this was fun to make, but it all balances out, and you can adjust all the assumptions. It's always going to balance as long as you're just adjusting the cells in light yellow. This just shows assets, liabilities, and equity based on all the assumptions. And you could minimize all those just to see. You could almost see all of it at once here in one screen. Balance sheet monthly, balance sheet annual, same thing, just on an annual basis. And then you've got cash flow statement. You've got obviously operating activities, investing activities, financing activities, all that aggregated over. And all these statements are all connected, monthly and annual. You got your annual here. And then M1 through M3 is a bunch of advanced logic I had to do to get the dynamic scaling stuff to work right, and with all the growth. You can see the growth logic here. We had years, the year something onboarded, and then based on that, in the year of their, essentially their life, or how the age of them, what their growth rate should be in that period. A lot of fun stuff here if you like math. But yeah, that's the model. Please support the channel, smarthelping.com as well. Check out the website. The template's $45 for this thing is very affordable, and there's so much value here, even if you're just trying to learn stuff. All right, that's all I got for you guys. See you on the next one.